What if I told you that your 401k or 403b was full of hidden, layered, and unnecessary fees that you have to pay each year, and that it'll cost you thousands for no reason over time? Keep listening as we dive in. All right, Paul, welcome to Money Meets Medicine.
Great to be here.
Yeah, I'm super excited to have you. Maybe the best place to start this is actually in the introduction I mentioned, because I was listening and researching for the show, that you sometimes describe yourself as a 401k vigilante or 401k forensic expert. And I think that in and of itself is a pretty interesting fact. So maybe let's just start there. Like, what in the world is that? And how did you become a 401k forensic expert?
Well, this really began for me about 20 years ago. And I always remember this conversation with a colleague of mine who was always very research heavy. He was always reading something. He was researching tax rules and reading like various parts of the tax code. And he always had really interesting facts for me. And one of the interesting facts he shared with me was, did you know, Paul, that you can look up companies' retirement plan tax forms online, not just 401k, but 403b, profit sharing? I'm like, whoa, how is this possible? Like, this is so crazy that this is public. But initially, I didn't really know what to do with the information. So a few years later, I started thinking about this a little more and looking into the tax forms more closely. And I thought, you know what? Why not just call some of these business owners and let them know what I'm seeing, especially in cases where I felt that the fees were particularly egregious on the advisor side and on what's known as the record keeping and administration side. And it just so happened that there was a company who's still around, is one of the big providers. I'll name them because it's public, John Hancock, who was involved in excessive fee lawsuits. So I started calling companies, especially companies I was seeing that were using this record keeper, John Hancock, and letting them know not only about excessive commissions that were paid to financial advisors, or at least very large amounts of money. I didn't know that they were excessive at the time, really, because I didn't know the industry, but also about these excessive record keeping fees and the fact that John Hancock was involved in these lawsuits. So it turns out that John Hancock was one of the providers that my firm had a relationship with, as one of the approved record keepers that financial advisors like us could recommend to their clients. John Hancock got wind of some of the emails that I was sending out, probably because I sent that to enough businesses where eventually someone forwarded it to their rep at John Hancock, and then it got back to their sales manager, and he kind of had a not so pleasant conversation with me. And my firm then informed me that I could no longer look at these 5,500 forums as a prospecting tool. And most importantly, I could no longer criticize anyone, including John Hancock, that my firm had a relationship with. Now, I don't even blame my firm, because other firms might have been even harsher with me and they might have just terminated my relationship. So that was around May of 2010. Actually, it was exactly May of 2010 when I left as a result of those conversations to go off on my own as an independent registered investment advisor, so I could provide objective advice and not have a muzzle put on me. And also because I had to do business on the 401k, profit sharing, 403b side as a commission-based broker. And I hated that model of doing business. I wanted to be an independent registered investment advisor and fiduciary. And most importantly, what I wanted to do was to be able to charge a fixed dollar fee rather than a fee based on the percentage of the total plan assets, because that was not commensurate with the level of services I was providing. And I'll add this, that Ted Benna, the inventor of the 401k, has echoed the same sentiments as me, that advisors are getting paid as if they're doing an original piece of work, which is just bizarre and inefficient. We can get to a little bit of that later, but they really need to get back to a fee for service model, just like accountants and attorneys. And instead of just focused on picking the funds, which is generic and a fifth grader could pretty much do that, they need to really focus more on simply helping people retire.
Yeah, I think it's actually an interesting distinction there too, because, and correct me if I'm wrong, what I think you're talking about is advisors for 401k or 403b plans, as opposed to necessarily an individual financial advisor that works with an individual client. Because I think that's a nuance there, that as I was learning and researching for the show, that there are advisors, and we'll talk about the 5,500 that I learned all about and that you're going to teach us about as well. But there are advisors listed on these forms that are theoretically there to, I guess, give advice. And it does beg the question, is this a 401k plan level advice giving where it's just picking the funds that are in there, which anybody listening to the show knows should not be super complicated. Diversified low cost index funds are not hard.
That's right.
But then the other question is, maybe are the advice services that are provided where they do actually meet one-on-one with clients that are participants in these 401k plans, which would be a very different level of service. And so I found it interesting that in those documents, it doesn't necessarily say what kind of advice is given.
No, and in almost all cases for the smaller plans, and when I say smaller, I mean fewer than 100 participants, and especially fewer than 50 participants, which are really the most unsophisticated plans, but those are the ones that are getting hurt the most. So by definition, it's actually not advice when you see commissions listed on line 10E, because commissions are otherwise known as kickbacks that are built into the cost of the mutual funds that can be paid not only to the broker that's only supposed to or only able to provide what's known as investment education rather than actual advice, but often it's kicked back to the TPA, and TPA stands for third party administrator. That's the party that's doing all the compliance work, the preparation of the 5500 form, and what's known as discrimination testing, which are these tests that have to be passed that are based on the proportion of contributions of the highly compensated employees relative to the non-highly compensated employees. And if these tests aren't passed and there aren't sufficient contributions being made amongst the non-highly compensated employees, then the highly compensated ones get what's known as redemption checks at the end of the year. In other words, they're not able to max out their contributions. So there's all sorts of nefarious ways in which service providers get paid. But the biggest problem, I think, well, there's just so many of them, some of which I touched on. But I think one of the most glaring is the fact that there's no invoice being sent, because to the extent there's an invoice being sent, even if the employer isn't paying, and you're always more responsible or responsive to cost and sensitive when you're physically writing a check, but if you're at least receiving an invoice to consistently on a quarterly or monthly or even biannual basis to reflect the fees coming out of the participants' accounts, you are naturally going to be much more scrutinizing. But when you don't, then you literally don't care. And you don't even care whether or not the advisor is meeting with participants one-on-one. Because if you don't even see a fee and you're not paying at the employer level, why would you even bother to check the extent to which the participants are even utilizing the advisor's services?
Yeah, it seems like in my research for doing this that the Form 5500 is filed annually. And so the person who signs the form, of course, can see the expenses if they take the time to actually look through this form instead of just signing it and saying, hey, I'm done with this task for the year so that we can have our 401k or our cash balance plan or our 403b. But outside of that, there's no way, as you're saying, from like a monthly standpoint to keep up with what those potential costs are if you are outside of that and you didn't know that the Form 5500 exists. And so I find it interesting, though, that you're pointing out the difference between, let's just say, large and small employers. And so in particular, I've heard on other shows, you mentioned there's kind of this 300 number where, at that number or less, people tend to be a little bit more at risk than with employers that are much, much larger. So what's the distinction between a group that has 100 docs versus a group that works for a hospital that employs thousands of people? Why is this distinction important?
On the record keeping side, and this is true in a lot of businesses, there's just more economies of scale. Of course, the absolute dollar costs are much larger with these larger plans, but the cost per participant is generally lower. But I will say, though, that even with the larger plans, with these larger fees, even though when you divide by the number of participants, it's a smaller per participant fee, the level of work to do in terms of the primary service that the advisors market themselves as providing is just, at least on the advisor side, regardless of how many participants there are, is the same. Because if you're just creating a generic lineup of index funds, not only does it not matter how much money is in the account, it also doesn't matter how many people are in the account if you're not even conducting one-on-one meetings in the first place. So that doesn't mean that the advisory fees can't still be ridiculous. I'll give you an example of a law firm that I talked to, one of the partners, that is a pretty respectable Chicago law firm. It has about 300 people, actually. The advisor was getting about 60 grand a year in fees. Now, on a per participant level, that's $200 a participant. That's way less than a lot of the egregious situations I see for much smaller plans. However, upon asking the partner what the advisor is actually doing, all he could tell me was, well, they're sending us reports. And I asked him, well, do you know how long it takes to provide those reports? To what extent do those reports actually add value in your decision-making process on both a plan sponsor and a participant level? Could you get those reports from pretty much anyone? Are they customized reports? I mean, just look at buying like a suit. Do you buy a suit off the rack? Or like you go to Nordstrom Rack maybe and you find some deeply discounted clothing. It just happens to be your size. Or do you want to buy a custom suit where they take your measurements and they put your initials on the inside of the sleeve? I mean, I have a lot of custom clothes, I know. And sometimes those aren't even that expensive, but there absolutely clearly should be a price difference depending on the level of customization that you have in any service.
Yeah. So maybe let's back up for a second and talk about this from a conflict of interest standpoint, because we're mentioning advisors. And we talk about conflicts of interest a lot on the show and incentives and what that ends up doing from the physician's perspective who's working with somebody in the financial industry, whether that be a financial advisor or a real estate a realtor or an attorney or an insurance agent. And so I think it's really important to talk about that when it comes to retirement plans. And maybe the first answer is, big picture when talking about administering a 401k or a 403b. Who all is typically involved in such a business? We're mentioning advisors, but I know that looking through these forms myself, that's not the only people on there. So who all is typically involved in one of these forms as someone listed on a 5500 for being a part of administering this 401k?
That's a good question. And I set my site up. I mean, I've updated my website since then, but about 15, 16 years ago, I thought about your question. And actually on my website, which is just paulsippil.com, there's a cost page. Just what are my costs? And then I list out all of the services and what they are. And the primary services and service providers you'll see, at least on the plans that have 100 or more employees, because that's when what's known as Schedule C is shown. And the service providers are labeled and broken out. Whereas on the smaller forms, known as the short form, you'll simply see commissions and or maybe aggregated fees on lines 10E and either 8F or 8G, but you don't actually see what services are being provided. You just see a number. So they are primarily known as record keeping, administration, custodial, and advisory services. And advisory services could be in the form of an actual registered investment advisor, and I'll get to those conflicts in a minute, and or a broker that's earning commissions that I described, otherwise known as kickbacks, that are built into certain investments and not others, that cannot be billed directly to the client, that have to be based on a percentage of plan assets, that are only built into certain investments and not others. The custodial fees, and I'll go on to that, is just like a Charles Schwab, Fidelity. Those are custodians. That's a very, very small fee, minuscule fee, but it's simply for what's known as custodying, holding the assets. The record keeping and administration fees get somewhat conflated. The administration, as I'd mentioned earlier, is that discrimination testing, compliance work, and preparation of what's known as the 5500 form, which is the tax form filed with the Department of Labor. The record keeping is literally keeping the records, like loans, like an 800 number for both the plan sponsor and the participants to call if there's any problems with the website, anything having to do with the website. The funds, there's a fund lineup in all these different plans, and different record keepers have different funds that they make available. Sometimes a plan like Fidelity, who has their own proprietary funds, will give you discounts if you use their funds, and that could be a conflict of interest. Whereas other providers like Ascensus, who I really like because they have what's called a total open architecture platform, and they don't have their own mutual funds. They simply offer flat fee pricing and no restrictions on the funds. I love Charles Schwab, who I use personally as a custodian, because that's a really true open architecture platform with no restrictions on the investments. But regarding conflicts, registered investment advisors do not get commissions, so they're said not to have conflicts. But they do have a conflict, though, when they're charging an assets under management fee, a fake management fee, when they claim to be managing the accounts, when in reality, it's just a bunch of generic index funds, maybe 20 different funds, sometimes customized models that the advisor creates, but it's still within the participant's discretion, which is why they're known as participant-directed accounts, to select any fund that they want. And what if somebody has debt, or maybe they want to take a loan from the plan? Or what if somebody has very high interest rate debt that should be paid off because it's 20% interest before you max out? Or maybe someone's saving for college for their kids, or they don't even have 6 months worth of savings. And maybe they need to establish a savings cushion so they don't have to take loans from the plan, which is not tax advantageous. That would be better to establish before maxing out of the plan. Sure, you want to get the full match first, But when you get paid based on a percentage of plan assets, your incentive is to always tell people, even if it's better to pay off your credit card debt first, to think first about maxing out your plan because it makes the advisor more money. Even though they are a fiduciary, if they're getting a percentage-based fee, then they are not in a very good position. They are in a conflicted position.
Yeah, I think this is an interesting one to tease out because historically I have been against an assets under management fee, even for individual clients working with individual advisors. My view's shaped a little bit differently now. And it's interesting because it's also the same based on what you just described. And I'll kind of get to the nuance. But for me, it really comes down to how much money am I paying for an advisor? And is the return on investment that I'm paying for, is it worth the services that I'm getting? And the prime example I give to people all the time is that if your advisor is really only helping you with investing, which is not complicated. We've talked about index funds multiple times on this episode. We talk about them all the time on the show. If that's all they're doing is managing a set of investments and not really doing anything else, that is not worth much money at all. It's worth a $20 book on Amazon about investing is about what it's worth. It's really not that challenging. And so if you are paying an AUM and that percentage is coming out of your investments so that someone can tell you just to basically invest in broadly diversified low-cost index funds, you are basically being fleeced no matter what the cost is because it's just not worth that money. I think there's a ton of other values that individual advisors provide, whether that's being the hub and spokes to your estate attorney or your CPA or the whole host of things that they should be involved in as that central person in your financial life, helping you direct those things. And when it comes to the physician world, being very specific about student loans and how to deal with those because there are specific nuances and needs that physicians have, or disability insurance, which is unique to us. If you're getting a ton of value, or maybe they're saving you from tons of arguments with your partner or your spouse, your third person objective, then I've got no problem with that number being whatever it is, as long as you think it's reasonable for the services that you're getting. What's not reasonable is having a hidden AUM that gets drafted each quarter or each month or however often it comes out, and you're not really meeting with them. And really all they're doing is quote unquote managing your investments, which are really just not that complicated to necessitate such a fee. And when it comes to 401k advisors, I mean, it's interesting that I've been at a very large employer for a long time. And I bet if I went and asked the overwhelming majority of people that I work with right now, if they knew that they have an advisor as part of their 403B at Wake, where I am currently, the vast majority, the overwhelming majority would say that they had no idea. I do know they exist because I do know some faculty that have talked to them, but I do also know that the overwhelming majority of people would have no idea that that's even an offering that Wake Forest is paying for as part of administering this 403B.
Yeah, there's a lot to unpack here. There's a lot of really, really good points. And I'll start with the value of a one-on-one advisor, like outside of the 401k, is understandable. If you're getting charged an asset under management fee, but you're talking to that advisor a lot and they're dealing with other issues outside of the simple management of the investments and helping calm you down if the market drops and you want to sell and like stopping you from making bad decisions. I mean, that's often the kind of value that advisors tout. And those are not bad points, but they do not apply to 401k plans because over 90%, probably 99% of participants never interact with the financial advisors. So all those areas of value don't even come into play. But for a really large plan where it's a very small per participant fee, it actually is incumbent and it should be encouraged by a university or a large medical practice or a large association or whoever with thousands of employees to continue to let them know that the advisor exists, because the advisor may be charging a decent fee in absolute dollars, but the fee per person is very low. So sure, if they don't use them, it's not killing them, but those are instances where an advisor can actually add a lot of value. And then of course they can add a lot of value in the smaller plans too, but the fee should be much lower. And I don't want to forget this point. In almost every single case for a small plan that's a medical practice, especially a medical practice, also other professional services firms like architecture, engineering, and law firms, they absolutely need to pay those fees at the employer level, without a doubt, because the fees at the participant level are paid with non-tax deductible dollars. Now, even if you knew there were fees, which most people don't, you still, even if you found them, you wouldn't be able to deduct them. But even if you could deduct them, a lot of people wouldn't even know to deduct them anyway because they don't see them. But these are paid with non-tax deductible dollars. And what do advisors tout? Tax deferred accounts are great. you should always put money in your 401k or 403b plan because it grows tax-free or tax-deferred, depending on if it's a Roth or traditional, which, by the way, a lot of people don't know the difference between a Roth and traditional 401k. And that's a huge reason to use an advisor if the advisor's helping explain that or helping use the retirement calculator that, by the way, you're paying for. But if you're being charged at the employer level, you're going to be more sensitive to the cost. You're going to save everybody else money. You're going to help motivate, attract, and retain key employees because an extra 1% in fees over a 30-year period for a 5-year-old with starting with $25,000 is going to cost approximately 28% of the balance and $67,000 over time, much more for people with more contributions and bigger balances. But maybe most importantly, when you get an invoice, you're more sensitive to the cost and you get a tax deduction. But I always like to say most importantly until I think of something even more important. And that is that the majority of the money is always held by the owners, the physicians or the partners or whoever that is. They're the ones paying the majority of the participant fees with non-tax deductible dollars. You're paying 80 to 90% of the non-tax deductible participant fees anyway. Shouldn't you just write a check and actually get a tax deduction, pay for all of it? And on a net basis, not only are you paying less, but you're reducing everyone else's costs down to zero.
So let's get into the weeds for 1 second. And I don't want to dive too deep into the weeds because most people listening to this have definitely not looked at a Form 5500. The first time that I did was in preparation for this show. And so the fees that are listed on the 5500 in terms of the expenses, I presume that those fees, because they land on that form, are expenses paid for by the participant. And if it is paid for by the employer, does it just not land on that form at all? Or is there another place you can find that?
My understanding of some of these forms are convoluted is you're not going to see the fee show up if the employer is paying the fees. So there's examples where the employer does pay the administration fees, usually like for the small plans, like $3,000 a year, or $750 a quarter, or something like that. And for that reason, they think they're paying all of the fees because they're paying some of them, and that's all that they see. But when you see, yes, to your point, like X amount of dollars show up on the 5500 form, whether it's the short form on lines 8F or 8G or 10E, or Schedule C of the form that has more than 100 participants, you have to add in the fees that the employer is writing a check for to arrive at the total true cost, not including the cost of the mutual funds themselves.
Yeah. And speaking of the cost of mutual funds, it's interesting because looking through these forms, Charles Schwab was one that was on one of the forms that I looked at. And the cost for custody honestly wasn't that much. It was less than $5,000 for a plan that had over $100 million in it and hundreds of people in it. And so it got me thinking, as a very large custodian, how they make their money. And naturally, it kind of falls back to expense ratios and 12B1 fees, which we talk about on the show a little bit because we're obviously very conscious of fees and the long-term ramifications those have. If you're paying a 1% expense ratio over 30 years, it ends up being a 7-figure number for a lot of physicians when you're saving quite a bit.
Yeah.
And so there are fees, it sounds like, that some of these people are making that may not be captured in that form, like the administration fee if it's being paid by the employer, or a 12B1 fee, or an expense ratio, or other things you might see on a prospectus that are going to go to the custodian like Charles Schwab or Vanguard or Fidelity or whoever's custodying the funds. And so there are other fees that get paid outside of what lands on that form. That form is just almost a starter in some ways.
Yeah, I mean, it's true that the mutual fund fees themselves will not get captured and the employer fees won't get captured, but the commissions do, because what you will see is both direct and indirect compensation. And sometimes there's one party that receives both. I'm not even sure. I've never had those arrangements myself, that they're actually receiving both direct and indirect compensation. Sometimes the advisor is receiving an upfront payment, and this is a particularly nefarious practice if you're not disclosing it and then reducing your payment in subsequent years. Because what happens is the record keeper may pay an upfront payment to an advisor, which is supposed to be a prepayment of the advisor's fees. And as a result of that payment that the record keeper has to pay out, they then have to compensate for that money they gave out by charging a higher fee to the plan sponsor on an ongoing basis. If the advisor takes that upfront payment and then doesn't reduce their fee accordingly based on what they would have charged had they not received the payment, then that's where people are paying a lot more than what they should have. And they don't understand, when the advisor's not charging them directly, that it's still going to be a cost to the participant. It's just not directly.
Yeah. So let's talk about maybe concrete, actionable stuff, because I found this personally very interesting. And naturally, I would host a personal finance podcast for physicians and written books on stuff like this. Love this stuff. But I think it was actually really interesting because there's a 5500 form lookup, and you basically need your employer's tax number, their employer identification.
Oh, no, you can just do the name. You can just type the name in.
Oh, I went and found the
Yeah.
EIN. I guess took the extra step, tossed it in there.
Yeah, that's fine.
Yeah, but you can use the name, even easier. And you can look it up. So maybe the question I want to ask is, let's say that somebody's listening to this. Maybe they're involved in their group's 401k plans, or they're part of the financial committee for their private practice, or maybe they're at a large employer and they're just kind of curious to see these numbers, because the numbers that are listed in there are fascinating. How much is in assets, where those assets are. So you can see how people are investing. Like, there's apparently hundreds of people at my current institution who are investing in whole life insurance products through their 403B, which is fascinating. Yeah. And obviously not something that we're huge fans of on the show, but it's interesting because you can look up the number of people that do it on the form 5500. And so if somebody wanted to look up their employer, their practice, their current plan, what do you think would be the highest yield thing for them to do as they go look that up? As a physician on the participant level who probably doesn't know a ton about this stuff.
I want to see what I'm looking for first. I mean, there's a lot of things you can see, like the plan assets, the total contributions with the employer and the employees, the plan design, and there's all these codes, and it's just kind of interesting. But what I want to see first is, what are the total charges? And if there's 10 or 15 people and I see $50,000 in charges, not only is that completely insane in proportion to only 15 people, but it's equally, if not more insane, that when the doctors have most of the money, that they're allowing those fees to be paid by themselves personally, when they could have written a check and gotten a tax deduction as they would for any other business expense, and saved their participants a ton of money. And the fact that they're not even getting an invoice for those fees. They're getting an invoice for the administration fees, which might be like 2 to 5% of the total charges. And therefore they think they're paying everything.
Yeah. Yeah.
That's what I want to see. And that happens all the time. There's no other group. I mean, law firms about equal than small medical practices that are getting abused on fees more than I have ever seen. And I've got lots of examples. And I even have an Excel spreadsheet of over 1,000 of the most egregious examples just throughout the Chicago area alone that I've compiled for 15 years with data going back all the way to 2009 of insane fees that are passed on to participants. And if everybody knew what was going on and listened to this, fees would go down by over 50% overnight.
Let's talk about this. They look it up. They find out that they're in that 15-person group. They're paying $50,000 in administrative fees. Because I've heard you say this in other podcasts, that the context matters. And so on a per participant level, what is a reasonable amount of money per participant to be paying for the administration of a 401k or a 403b?
I have to use this firm, Ascensus, as a great benchmark. Ascensus is a national firm. I have no financial relationship with them whatsoever. I get nothing whatsoever from them if I recommend them as a record keeper, administrator, and custodian. They charge, unless their fees have changed, at least as of a few months ago, I believe I have almost memorized their fee schedule. I believe it's $4,250 for all of the record keeping, custodial, and administration services combined for plans with 20 or fewer participants. And then I believe it's $70 for each additional participant above 20. And then there's an extra $800 or $1,000 or so annual fee for what's called new comparability cross-tested plans. And that's just a fancy way of disproportionately allocating the profit sharing contributions to the highly compensated employees. So let's take an example of a plan with 25 people. And let's say they're doing the cross-testing, which most medical practices and law firms do, because they have big contributions and they have highly compensated employees, and it doesn't cost that much to have more of that profit sharing contribution go to them. So let's do the math, $5,000 divided by 25 people, $200 a person. I mean, that's not an unreasonable fee. I don't think so. And I think a reasonable financial advisory fee is somewhere around $5,000 a year too. Now, it could be more to the extent that someone like myself is spending more time on a regular basis with participants. I mean, you could spend more time as an advisor on a 20-person plan than a 80-person plan, just depending on the level of activity. But when you use Ascensus as a benchmark, they're not the fanciest firm. They don't have the best website in the world, but for small basic plans, how much more do you want to pay for a fancier website? Like, you have to break those numbers down the way you would break down different fees for different cars. Like, I drive a used Toyota Camry. That's all I like to drive. I know exactly what I'm getting. I know the price based on the condition, the year, the make, the mileage, how many accidents it's been in. I can pull up the Carfax report. There's no reason that you shouldn't break down all the features in a 401k plan the way you would break down the features for a car. And when you have plans charging 0.5% with a company that has 25 people and let's say $5 million in it, you could easily be paying 25 grand combined in record keeping, administration, and custodial fees, whereas a census does all of that for 5,000. Is it worth the extra $20,000 for the additional bells and whistles? And a census's service isn't that bad. They have what's called 360 payroll integration, which makes, as a human resources operations person, a lot easier to deal with uploading contributions and participant changes. They're not a bad firm, and the smaller and more basic your plan is, the less you need to be paying Cadillac prices. And oh, by the way, some of these more expensive firms have more restrictions on the funds, whereas a census not only has a true, complete open architecture platform, but they also allow for what's called a self-directed brokerage account, which opens up the entire universe of funds to everyone. Now, they do say they limit it to like 75% of the assets, but I don't even know how they completely monitor that. And again, if you really want a fund, you can pretty much add anything to the default list of investment options. So I'd love to understand, if you have a small basic plan, why you should use a firm other than a census that's more expensive based on the cost, services, and technology and ability to select any fund that you want.
Yeah. And obviously, being brand new to the space, don't know much about a census, but it is interesting to me that they have that $70 per participant kind of ideology in there. And of course, there's that initial setup fee, let's call it, that $500 or $7,500 that it might be to do that in addition to the 70. But then as you theoretically get to larger groups of people, like if you go from a group of 25 to a group of 100 or 200, 300 or 1,000 people, economies of scale would suggest that $70 per person would adjust and come down.
That does come down. Actually, when you get higher, it gets to like 50 a person. And a census is more popular amongst the smaller plans. There's more price compression as you get into like thousands of participants, where the difference in fees on a per participant basis becomes very small. It's just the smaller plans. That's where there are more egregious differences between one provider and another. And I wouldn't worry as much about the total cost for these larger plans. And in those cases, I think more about the bells and whistles and the level of service, because when you have several hundred or several thousand participants, that's not really where you see a lot of the census plans. Like most of their plans, and they do have a bunch over 100, between 100 and 200, but you're not going to see a lot of them over 1,000.
Yep. No, that makes sense. So naturally, the next question is, right, I look up my form 5,500. I see that I'm paying $80,000 in fees for my group of 50 people. And that seems to be a very unreasonable number based on everything you just described. What is that person's next course of action? Or like, what have you seen has successfully helped people? Because I can tell you that in my world, most physicians, which means most of the partners that we work with, most of our colleagues, some of which who might be the person on our private practice that's responsible for this, hopefully not, since they're managing the 401k, but they're not super financially literate. And so you go to try to explain these things to people, and maybe they have a hard time understanding, or maybe they go to the 401k administrator and naturally they're going to defend their position, which is what happens. The same exact thing that happens with whole life insurance. You explain to somebody why this is probably a terrible idea for you, given you're very new, out from training, you still have tons of debt, you're not doing financial things that make sense, like maxing out certain retirement accounts or investing towards your future, and somebody sold you this policy. And then they naturally take all that information, they go back to their whole life insurance advisor, and they say, no. Here are all the reasons why all of this is very reasonable. When someone sees that they have an unreasonable fee based on what you just described, what has been shown to be successful in your experience in terms of going back and negotiating it or changing, or what's the next step?
Yeah, this happens a lot. So let's think about which fees we're talking about first, because depending on which provider you're talking about, you'll get different answers. One really easy thing to do that requires no financial acumen that advisors falsely claim you need them for is negotiating fees with the record keeper, such as John Hancock, Principal, Voya, Fidelity, whoever. A lot of these providers, unlike a census, which is really rare because they have their own custodial company, a census trust company as well, and their custodial fee is actually included in the fee. So there's no percentage whatsoever. a lot of these providers will charge a declining percentage, but they don't even necessarily reduce the percentage automatically based on certain breakpoints when you hit certain numbers, like you go up to 3 or 4 million. But if you literally just call and ask, and I've done this several times with companies that aren't even my clients yet. And so the advisors not only get overpaid, they don't even bother to tell the plan sponsor that they can simply, without any financial expertise whatsoever, call the record keeper and ask them to charge a lower percentage. Because sometimes plan sponsors don't want to go through the whole process of switching. They just say, I don't want to switch. I don't have the time. I'm like, all right, how about you call up John Hancock? They're charging you 0.5% and see if you can get that percentage lowered. Well, how do I do that? You ask them. Literally. And they don't fight because you're just talking to some rep. It's a company with thousands and thousands of employees. So they don't even fight with you because they know if you're smart enough to ask for a fee reduction, which 99% of people aren't, they're just not aware enough, then you're also sophisticated enough to probably move from them too. And you don't have to tell them that. The very fact that you're asking shows that the plan is probably being shopped. You don't even have to do anything else. And a 10 basis point reduction, like 0.1%, on like $4 million, that's a hell of a lot of money, $4,000 for a simple phone call. So that's the record keeping side. There's no pushback whatsoever. On the advisory side, sometimes there's pushback, but when the advisor is not doing any meetings with the participants and the funds haven't changed for 5 years, and oftentimes they haven't even talked to the advisor for 5 years, the advisor has literally nothing to say. And I have to share this because it's like the best story ever. It just happened last week. One of my potential clients, they're not even a client yet. They literally just did this with John Hancock or in the process of doing this. And yes, it is John Hancock. They didn't even know they had an advisor, which does happen. But this is the craziest thing that I've ever heard about. The administrator of the plan, the internal one, the HR person, Googled who the advisor was because they had to ask the administrator who the advisor was, who got nearly $10,000 in commissions, $9,730 in 2024 to be exact. She didn't know who it was. So it turns out the advisor's been dead for 14 years.
No way.
Dead. They were paying a dead person. I mean, that's like voting in Chicago. I mean, all my years, I thought I'd heard everything. That was something I would never have thought I would have ever shared, but that's what happened.
What's the recourse for that? What happened?
Maybe it was someone else at the firm. I don't know where the money's going. I'm still in shock. Well, if the person's dead, like at some point there had to have been some notification that the bank account has been closed.
You'd think.
I don't know. I mean, we can get into lawsuits, but this would be a good example. The problem is that attorneys don't care about plans of this size, even when the participants are being hurt the most because there's not enough money in it. And ironically, the lawsuits for the larger companies with hundreds of thousands of employees with much bigger dollars really aren't helping the participants because it's really only an extra $30 a year per participant. So I'm not saying it doesn't help at all,
Right.
but it's really the attorneys that are benefiting more than the participants.
That's unbelievable. But it also makes sense. It kind of reminds me of like when people have subscriptions to things, they don't realize that they're just going off every month because they never look at their credit card statement. I'll get emails occasionally about people like, hey, I've got this subscription that I need to cancel. And we all do it. Like I literally, ironically today, just happened to cancel some of my Apple subscriptions that I have because I got a notification that like one of my payment things needed to be updated. And I looked at it, I was like, I haven't used that in like 18 months. And so I just canceled it. But this is obviously a much higher form, much more egregious example of just this ongoing payment that's going on in the background because you're not really attuned to your practice's financial situation and the 401k management. It just keeps getting paid, even though the person's dead. I mean, that is mind blowing. In terms of concrete action, it sounds like the lowest hanging fruit, if I'm understanding this correctly, is to at bare minimum, if you have a practice, get the employer to pay for any fees that are associated, because at least it's a pre-tax deduction as opposed to the person getting hit.
In the cases where it's in the employer's best interest, where the employer, him or herself, or partners or owners have the vast majority of the balance. That's not always the case where it's like, I don't know, a manufacturing company with like 50 or 60 employees and, you know, the owner may only have 10 or 20% of the balance in some cases. And maybe it's a bunch of key employees that have the largest balances, in which case the owner doesn't want to pay for all the fees. But this is what happens a lot, especially in professional services firms where the employer should be paying. It's often a family friend or a family member
Always.
who's the broker. And this is where it's just highly unethical, where even though a lot of it's your money, you're still using a lot of the other people's money to facilitate a payment to a family member or friend in amounts that are way, way beyond what should be paying based on what the actual value of the service is, which in a lot of cases is zero.
Yeah. And we run into that all the time on the show, just in general. I give this example all the time of Milgram's psychology experiment where they were like, we want to know how normal German citizens were complicit in genocide in World War II. Now, the study is highly unethical and they recognize it after the fact, but the findings were interesting nonetheless, which was essentially that if you have an authoritarian figure in the room telling you that you need to keep doing things, you'll keep doing them even if you feel like it's not necessarily right to do them. And so I always try to tell people, just because it's your brother or your cousin Bobby or Susie or whoever it is, or if the person that's managed your parents' finances for 40 years, doesn't necessarily mean that A, they're doing a good job. And B, if you find out that they're doing a bad job, it doesn't mean that they're a bad person. They may work for a company that has, let's just say, certain disreputable methods of doing things that they don't realize are not what's best for people. But because they work for that company, they feel like they are, because the company says, hey, these are good for people. And let me explain why. And they've kind of been, brainwashed in some way. So people have a hard time often separating the bad advice from bad person thing and realizing, like, actually, there are really good people that are in bad cultural environments in terms of where they work. And there are common examples in the physician space of where people get sold whole life insurance products very inappropriately. That person selling it's probably not a bad person. Like, you probably go to a basketball game with them, have a beer with them, spend some time with them over a meal, and find out that you don't think that they're a bad person, and yet they're doing things that aren't what's best for you. And so it is really tough to untangle for people when it's a family friend, it's a family member that's associated with these things. And I agree with you. It does make it more problematic. It does appear to be more unethical. Because I want to sleep at night, I try to tell myself that maybe it's a good person in a bad situation that's doing a bad thing, but it's unbelievably common.
Oh, yeah. And even if they're doing a good job, and this is what I always recommend, look, you're never going to switch from your advisor, but maybe you still want to use a different record keeper, or at least negotiate the record keeping fees, which have nothing to do with your advisor. And oh, by the way, how much do you want to pay the person? I'm not saying switch from them, maybe pay them less. And if you don't want to pay them less, wouldn't you be better off writing them a check so you can get a tax deduction?
Yep.
And a lot of times, and I just make calls to people a lot that don't know me, that they'll just say, well, I'm just not interested. I'm like, well, I'm not offering you my services. These questions just aren't being absorbed. It's just not resonating or whatever, or penetrating with them. So they just don't want to think about it, I'm guessing.
Yeah, I totally get it. Paul, this is a super interesting topic we definitely have not discussed on Money Meets Medicine before. And so if people want to hear more from you, hear more about Form 5500 or how to look through these things better, where is the best place that they can find you?
They could just go to my website, paulsippil.com. That's SIPPIL, or just literally type my name into YouTube. There's lots of videos I have just on my YouTube channel. There's videos on my website. There's also a blog. I've written quite extensively about the industry. If it doesn't bore you to death, there's a whole litany of information that you can find. So please feel free to reach out, and my contact information is on there as well.
Awesome. Well, this was great and super helpful. And I learned a ton just preparing for the show and talking to you today as well. So thanks again for coming on Meets Medicine.
Thanks for having me.
Justin Harvey is a certified financial planner at APM Wealth, where he helps anesthesiologists and pain medicine physicians. Dr. Jimmy Turner is a practicing academic anesthesiologist at Wake Forest in North Carolina. He's also a licensed insurance agent. However, either Justin or Jimmy are your financial planner, investment advisor, or insurance agent. This show is expressly for general education and entertainment purposes only. Nothing should be considered financial advice. All views expressed are solely the views of the guests on the show and do not represent the views or opinions of their employer.